and about the overall market scenario. Joining us right now, Vinod Karki, the Vice President and Head Strategic Research at ICICI Securities. He joins us on the show right now. Vinod, hi, morning. Heartening to see the data that my colleague just highlighted, that some of these beaten down mid-caps are really making a comeback. Is right now the time to begin cherry picking and nibbling into some of the mid-caps, which were extremely attractive 4 months back, but have fallen quite a fair bit in the last carnage?
Well, yeah. So, hi, good morning. In terms of mid-caps, so we did look at these the mid-cap space, and what we realized was that if you see last year, calendar year, the outperformance was significant, right? Especially the mid and small was even higher. Now, to be sure, the correction was warranted, right? Now, to what extent is the only thing that market participants are trying to understand. It's not as if all these mid-cap companies are don't have any fundamentals around them, and these are real companies which are making real businesses. So, the question only remained was how much would be the correction. So, if you see in the last 2-3 years, the corrections in mid caps have the bigger ones have gone to as much as, let's say, around 30% odd. That's what we saw. So if you see from the this year's peak, the correction already is, I think, in the small caps especially around 25%. So my guess is, going by past history, something like a 25-30% kind of correction is a decent enough correction. So one should start looking at quality companies which have corrected. So that would be the approach here.
Right. So, Vinod, give us a sense, what is it that you're advocating to clients right now in terms of what you expect to happen on the earnings profile of a lot of these mid-cap companies? Because we're getting into that zone, right?
Sure.
And maybe if earnings look up, that would be a support for mid-caps?
Surely, I mean, earnings have been, so we did a factor analysis where it was coming out clearly that earnings was one factor which was driving stock prices and continue to drive. So if you see even this year, wherever, despite the huge volatility in the market and correction in some of these spaces, there are a bunch of stocks which are making all-time highs, right? And this is only on the back of earnings doing well for these companies. But last week we ran this analysis, and so where we thought, we keep obsessing about just earnings, but what about the balance sheet? So we did this analysis on balance sheets of India Inc. And there what we realized was, unfortunately, the balance sheet you just get once a year, but now since reporting has started for half yearly, you get half yearly balance sheets. So we thought, let's look at the balance sheets also, how the balance sheet is moving. So we analyzed some 3,500 non-financial companies' balance sheets, and we got some pretty interesting insights over there. One was that the capex cycle is not as broad-based as one would have wanted. Although in terms of sheer number, so we looked at these companies, and what we realized was the gross fixed asset growth in FY18. That's the latest number, by the way, for the balance sheet number. The growth was around 9.4%. Now, this growth in gross fixed assets is broadly in line with the nominal GDP number that we saw for FY18, which is around 10%, and the gross fixed capital formation number, which is a larger capex number in the whole system, which grew by 9.8%. The ballpark number is there in line with the macro numbers for the listed non-financial companies. But when you look at, when you deep dive into the numbers, what we realize that it is very narrow, in the sense 1/3 or 32% of the gross fixed asset addition is from PSU companies, right? And few other sectors like, the capex heavy sectors like the energy sector, telecom, and so on and so forth. So utilities and in some other industrials. So now, what is happening is the government is trying to do the maximum in terms of kickstarting the capex cycle, either through budgetary allocations, and if not through, if the fiscal situation doesn't allow them to spend, they are doing it through the PSU balance sheets, right? So so that is one insight that we got, that bulk of the capex revival effort is coming from the government, either through budgetary allocation or through their the PSU companies. The second is more insightful, which also gives you a sense of how the balance sheet de-risking process is happening, is if you see bulk of the fund mobilization, resource mobilization. So the aggregate number for this gross fixed asset or the capex was around 5.3 trillion for the whole of the India Inc. If you see the resource mobilization side, the equity resource mobilization was to the tune of 3.5 trillion rupees. So and obviously this is after the depreciation charge. So what it means is that India Inc. is more than has enough equity resources to fund its current capex requirement. Right. Now this is on back of around 850 billion worth of equity issuances in the non-financial space, and the aggregate PAT number of around 4 trillion minus dividend and buybacks, you would get a number of around 3.5 trillion. So this number is more than enough to fund the capex. So what is happening is, by this, because you don't require any debt capital, the mobilization in debt capital is virtually flat. So if you see, on a base of around 27 trillion of outstanding debt of all companies, the addition was only about 400 billion, which is a growth of 1.3% for FY18 overall. And if you look at the bank credit, which is part of this, it was even lower. So last year, if you see in the industry-wide number, the bank credit grew by around 0.7%, right? Rest was the credit disintermediation through bond market, mutual funds getting a lot of money, deploying that into corporate bonds, and which continues to be a trend. So on one hand, you have equity funds which are more than enough to fund your capex plan, and which is resulting in no debt issuances. So what net effect is that the debt to equity ratio for India Inc. has actually dipped from 0.86 to 0.79. So that's a clear de-risking of the balance sheet. And also, if you see the cash balance in the system, that's also gone up from 14.7 trillion to 15.1. So net, what it means that although on the one side the P&L, which we keep obsessing about all the time, is improving in terms of earnings growth picking up, but you have to also see that the balance sheet is also making a good comeback, after all the stress that we had in the prior periods. So, as the cycle improves, this healthy balance sheet, the strong balance sheet of India Inc. will allow us to kickstart the next private cycle, capex cycle that we have.
Okay. Seems like a recovery should be well in place. Vinod, would have loved to chat a little bit more, but running out of time, and you've got the all-important NCLT verdict as well on Cyrus Mistry as well as the Tata Sons board. So I'm going to have to let you go on that note. Thanks so much for joining in today.